Buy and hold is the most repeated advice in financial media. Warren Buffett's name gets invoked, the historical S&P returns get cited, and the conclusion is always the same. Don't trade, just hold. The advice is excellent for index investors with 30-year horizons holding a diversified basket. For active traders holding individual names on weeks to months time frames, the same advice destroys the math. Different time horizon, different concentration, different risk profile, different rules. Today, why investor wisdom fails traders, the drawdown asymmetry buy and hold ignores at trader timescales, and the trader's version of the same wisdom that actually works. Here's the framework. The investor works with a 30-year horizon holding a broad index. Most short-term drawdowns are noise. The long-term arithmetic of equities makes buy and hold rational. The trader works with a weeks to months horizon holding individual names. Single stock drawdowns of 50% or more are common. Recovery is not guaranteed. Concentration risk is enormous. The trader can't afford to hold through structural breakdowns the way the investor can hold through index pullbacks. Same wisdom doesn't transfer. The trader version is trend follow until structure breaks, capture the up moves, exit on the breakdowns. Watch this in a synthetic individual stock chart. A trader bought at 100, watched it run to 130 and held through the inevitable pullback. Buy and hold, right? But this isn't an index, it's a single name. The pullback turns into a structural breakdown, lower highs, lower lows, sustained downtrend. By the time the trader admits the trade is broken, they're sitting on a 50% drawdown that might take years to recover from, if ever. The investor advice of just hold assumed broad index diversification that this single name position never had. Catastrophe by category error. Here's the trader's version of the wisdom. Hold a position while market structure supports it, higher highs and higher lows, price above key moving averages, trend intact. The moment structure breaks, failed higher high followed by a lower low, price closes below the structural moving average, exit. That's the trader's buy and hold as long as the chart confirms the thesis, exit when it doesn't. It captures the long up moves the same way buy and hold does, but it doesn't sit through the breakdowns that would take years to recover from. Trend following is buy and hold for traders, just with an exit rule attached. Now the trader's correct version. Trader buys, watches the trend extend with higher highs and higher lows above a rising 50-period moving average. They hold not because of the calendar, but because the structure is intact. Each pullback that holds the moving average is a reason to keep holding. The first close below the moving average plus a confirmed lower low, that's the exit signal. Same chart, same trend following posture as buy and hold, but with a defined exit that protects against the structural breakdown the investor advice ignores. Trade lasts as long as the trend lasts, then it ends. On a real chart, the workflow is clear. Pick a structural moving average appropriate to your time frame, 50-day for swing traders, 200-day for position traders. While price holds above that average and structure shows higher highs and higher lows, you hold. The moment both conditions break, you exit. That's the trader's version of buy and hold. Capture the trend, exit the breakdown. The math is on your side without the catastrophic single name drawdowns the investor advice ignores. So, buy and hold is investor advice for 30-year horizons and broad indices. Active traders on weeks to months time frames with single names need a different rule, trend follow with a structural exit. Hold while market structure supports the thesis, exit when it breaks. Same wisdom, capture the long trends, applied with the math that fits a trader's horizon. Subscribe for the full method and trade your own plan. Education, not financial advice.